Hi, guys, and welcome to the 24th episode of the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we start off with the chart of the S&P 500 SPY. The red arrow here denotes Monday, Tuesday, Wednesday, basically flat, and then Thursday, Friday, gaps up in trading. So it wasn't. I mean, it's basically this week is basically a continuation of last week, only to a lesser extent. Like last week, we went from here to here, which is like a 8% move, and this week was like a 3% move. So let's talk about the technical picture first. Okay, where do we stand? Like we said, basically it's just the same as last week. We are still not really bearish, I'd say neutral, but let's bring in some moving averages here. Since we are right close to the 200-day moving average, and we cleared the 50, which is positive, close to the 200, we're still in technically bearish territory, okay? But it's bearish, but if you look here, if we can draw a trend line here, we broke this trend line. I don't know, I'll just draw it once so you guys can see it here. If you connect these 2 points here, so we broke the trend line, we're going above it, so we're bullish from this perspective, okay? Let me just kill it. But we're still under the 200, so technically we're in bearish territory. I guess we're neutral, okay? However, technically speaking, we mentioned this last week, we have the 1, 2, a higher low, and we broke above this level. So we broke the downward trend line, and we formed a higher low and broke above this the high right after the initial bounce. Okay, so this is bullish, yet we're still approaching this 200-day moving average, which should be huge resistance. Okay, so let's just call it neutral. Okay, because we are bearish underneath the 200, but we've ticked off 2 boxes for bullishness, which means we broke this trend line and we formed a higher low that broke the previous high here. Okay, so I guess maybe call it neutral, and yet the momentum is with us. Okay, however, we mentioned before that each one of these horizontal blue lines is a technical support or resistance level. Okay, the first one that I was looking for, as we mentioned last week, was the 550 level, then the 565, then the 575. Last week we hit the 550, and this week we're above the 550 and above the 565. Okay, we closed above it. However, the 575, which coincides with the 200-day moving average, will be heavy resistance in my view. I think this is the big level. Okay, so this is what we should be looking at, and maybe here we should be selling a little bit this entire time, which I was, but you should be selling more at this level. Okay, right when it hits the, we might get that in the beginning of next week. Okay. So we're approaching my 575 major, or let's say 575-ish, and whatever the 200-day is, 573, whatever that is. Okay, so we're very close to it. You should be taking profits here, still maintaining a long bias, expecting a hit and coming down. Now, after that, we don't know. Okay, we could take a hit and form another. We can go down back to the 550 level and still be bullish because we're forming higher lows. Okay, and what I'm looking for, as mentioned last week, is if we happen to break the 200 and trade above it for a week or more, then that is very, very bullish. We will be in total bullishness. Okay, we would have a bullish technical picture. Here, the technical picture is, I would say, neutral, because technically we're still bearish underneath the 200, but we've ticked off, like I said, a couple of bullish boxes. So right now, let's call it neutral, and waiting for a possibility of breaking above it. However, you should still take profits here because I believe this is going to be a very tough resistance level to break. Okay, that's just the technical picture. Okay, so look at some of the sentiment indicators. The fear and greed index is still at fear. Okay, so we still have a long way to go. Even if we get to that 575-ish level, this might be a neutral. Okay, we should take profits still, but we are not into the greed or extreme greed yet. Okay, and if you noticed, the AAII came in again at even more bearish than before. This is for this week. Okay, so even given for the past 5 days, which came out Thursday, so these 5 days here is what the new survey took. So people here are even more bearish than they were here. Bearish, not bullish. As the market went up, they're bearish. Okay, so we have a lot of, and the positioning is bearish for a lot of like hedge funds. So we have still a lot of people positioned bearish. Okay, with sentiment still at fear, getting better, but still at fear. Okay, what a difference a day makes, or a couple of weeks makes, when we saw this at 3. Okay, so this extreme bearishness with the bullishness going down is not good for the bears, at least in the short term. Okay, so we could hit this, maybe go down, maybe gives the bears some little hope, and then go back up again. Okay, because remember, SPY, no matter what you think of it, is a net positive drift asset. It tends to go up over time. Okay, and if you look, I mean, if you calculate from the highs of SPY of 613 to the lows, which was, I don't know, we touched the 480. That was the low. It didn't close there on that day, on April 7th. Okay, but that level, okay, that's a drop of 20% from the high. So technically, we had a technical bear market for a split second, for just, I don't know, an hour, whatever that spike down was in the morning. Okay, so coming from a technical bear market, 20%, people massively still short, and getting these bullish check marks, I don't know, with sentiment still near fear and, bearishness, extreme bearishness, I don't know, we could still have legs. We could just hit this briefly, go back down, and then go back up again. You have to be open to the possibility. Okay, because we know that the technical picture here was bearish. Last week we noted that the technical picture was bearish still, but the macro was still bullish. Weakly bullish, but still bullish. So we had a divergence. We were technically bearish, but fundamentally bullish. Here we're getting more and more technically bullish. Okay, and as you'll soon see, there was a big macro week this week, and the macro still hasn't turned bearish. Okay, we'll get to that soon. But right now, an overview of the technical picture is that we've ticked some bullish boxes. However, we're still under the 200-day, which is bearish, though, and yet the sentiment indicators are still bearish. Okay, so we have, which is a contrarian indicator. So we have a lot of check marks into the bullish camp this week. Okay, so I would say the overall end of this picture is neutral, technically speaking. Okay, so now let's move on to the macro portion. Let's clean this up a bit. Let's get rid of the moving averages. Okay, I'd keep this here like this. Oh, another interesting thing is that we hit this long-term trend line from the 2020 lows. Okay, that's just an interesting side note. Okay, but let's move back into the macro. The first thing that we hit in the macro was on Wednesday, was the GDP number. Everybody was looking at that, okay? And GDP came in at minus 0.3% for the first quarter of 2025. Okay, everybody was freaking out. However, everything comes up with an asterisk. Everything, there's a what if, there's a little question mark here, because this, people tend to think that, well, the definition of a recession is 2 negative GDP quarters in a row, and we got 1 technically, but this hides a big picture, okay? Because of Trump's tariffs, people were front-loading imports, okay? And if you look at here, I downloaded this from Zero Hedge. This is the component of GDP, Q1 2025 GDP, And this blue area here is the component that's made up of imports, okay? Which, if you can see here, I don't know if you can, it's a minus 4.83%. It contributed negative 4.83 percentage points to the GDP figure, which is minus 0.3%, okay? So the imports, front loading of imports due to the tariffs was what caused it to be at minus 0.3. Without this, maybe it would be at minus 2, and the GDP would have printed at our usual 2 to 3%, okay, which is our bullish meh figure for GDP, slogging along, I don't know what you want to call it, but limping along at 2%, 2.3%. That's still a reason to stay bullish, okay? So although the GDP figure in our macro, our first big macro of the week, was minus 0.3%, in reality, we know that it could have been around this 2% level, maybe 1.8, okay, because of the front loading of the imports, okay? So I would still check that as a positive on our macro, okay? And if you see, like, in relation to that, the GDP Now forecast came in for the Atlanta Fed GDP Now forecast, which tends to be pretty good. The initial estimate for the next quarter, Q2, is at 2.4%. Okay, so it's very preliminary. There's not a lot of data, but based on what the Fed thinks initially for the second quarter coming up of 2025, they expect GDP to be at 2.4%, which is around what it should have been if people weren't front loading, maybe 2.2 to 2.3, 2.4, whatever. Should have been around that level without the front loading of imports in Q1. So all of this GDP macro component, for me, checks the bullish camp. And the other big thing that came in macro-wise is the Fed's biggest inflation indicator is the PCE, especially core PCE. And no, it's not 0.4, it's actually right here. You can't even see it. Right there, it's hiding in front of you. 0. Everybody's thinking there's going to be massive inflation with the tariffs. 0. Okay? Because there are other forces. Tariffs could be deflationary. We don't have real world, we have theoretical studies that show that tariffs should be inflationary, but they don't take in the deflationary component of people not buying as many goods. Okay, so the jury's out, practically speaking. And if we look at Trump's first term, inflation was still at 2%. It never moved despite his tariffs. So now we have PCE, core PCE at 0%. PCE came in at 0% too, the headline PCE. So inflation is falling. It's not going up. So another check mark into our bullish thing. Falling inflation means the Fed is most likely gonna, lower rates. But if GDP is good, which we saw here, GDP, forget this, it's this is what we should look at, it's probably around 2.3%. Then what will the Fed do? Well, let's look at this is the Fed Watch tool. It shows you what the expected meeting next week for May 7th, what they're expected to do, and they expect to hold steady. I mean, if we were getting some kind of recessionary signal, this used to be during the April, when everything was crashing, this was up to 30-something%. Like the odds of a rate cut were about 35%. And now they're back down to 2.5% as the market goes up. The Fed's not going to do anything next week. Okay, they're just going to stand pat, and that's good. Okay, it just goes to show you that this entire move down GDP, usually, if it was real, the Fed would be cutting into this because we hit 20%. You would see like rate cuts going through the roof. The projection of rate cuts going through the roof. So the fact that we have the CME tool at nothing, the Fed is not worried, and the GDP component is at 2.4% projected for the second quarter, again, this is positive for the economy. Okay, so we have those two things checking bullish boxes or macro bullish boxes going forward. So what else came out? We had the ISM manufacturing came in. As you know, that's one of the things that we look at. and ISM manufacturing came in at 48.7. Okay, that's bad because it's below 50. It's contracting, but they were expecting it to be at 47.2. So it's higher than expected. If you look at the 10-year average, we're coming up from doldrums, still below the 50 that we like, but we've been below 50 since what? 2022 October. So like 2.5, 3 years of below 50 manufacturing. We still had the markets ripping. However, if this goes up and above 50 and expanding, we're going to go into new highs. Market up 10, 20% if we have a manufacturing boom. Okay, we don't know. So the manufacturing, although contracting, was better than expected and rising from the trough of 2024. Okay, so I'll put that in the neutral category. It's not super bullish because we're not above 50, but we're coming up from expectations. Okay, so the ISM manufacturing index is neutral. So what else did we have? Obviously, we always look at the initial claims. Okay, don't worry, we'll get to the big one coming up today. But the initial claims came in at 241K, which is a lot. It's starting to spike. I mean, it could be these one-offs and then come back down again, but we're still at very low levels and it's not spiking continuously. Okay, and that's why we knew that the non-farm payrolls coming up, which was the big one that everybody was looking at today, was probably not going to be bad because we had initial claims not exploding. Okay, initial claims were fairly low and muted, so we should have expected the job numbers to not be that bad, and we'll get to that soon. But so far, nothing to worry about here, though it should be noted. Okay, so this is still positive, but it should be noted that if it continues, it's bad. Okay, and the big one that we looked for, the non-farm payrolls, came in at 177K. What were they expecting? They're expecting 138. So a beat, huge beat. Okay, so jobs not cratering. Where's the recession? All of this macro that we talked about, the initial claims, the jobs, the GDP coming in, the PMIs, the Fed watch, okay? All of that is reflected in the chart. It goes to show you that this entire move that happened here in April was 100% fear-based of what might happen with tariffs, okay? But it didn't really affect anything. Employers here are not laying off anybody. They're not laying off people. They're still holding on. So, you have to be open to the possibility that you're wrong, that it might not be massively recessionary. And I mean, maybe we get a recession later on this year coming up, who knows? But so far, the numbers right now as we stand, no recession. You have to accept that. Okay, and we're starting to turn around into a bullish move. The key is the 575 level, I mentioned it. Okay, but so far the macro that we see, the GDP now forecast, okay, the current thing was minus 0.3, but most of that was front running of the tariffs. As we saw here, mostly front running of tariffs. The core PCE, let's not forget, 0, falling. We're not having inflation. Okay, it's deflationary. The Fed watch tool, they're not going to cut rates. I mean, if something bad was going to happen, they were probably going to cut rates in May. Okay, what else? ISM manufacturing, better, not great, but better. And of course, all translated into a non-farm payroll, as we saw from our initial claims that it wouldn't be that bad. So, macro, still bullish. You have to admit it. Until things change, it's barely bullish. It's not a rip-roaring bull market, but we're okay. We're limping along. We're still growing slowly. Okay, so that's the takeaway from this week. Okay, so let's talk about certain situations that we talked about last week, and let's follow through this week. Okay, the first thing that we mentioned last week was the oil trade. Okay, that turned out great. As you can see, where is Monday? This is Monday. So the oil trade that it took around here, let's look at the bigger picture of oil here. Okay, as you can see, downtrend broke a long-standing support, and it's trading underneath that support. I initiated the short around here as it was coming in. Not a full position because I was hoping it would touch it and I would enter my full position before going down. So whatever, I'll take it. Oil is beautiful because the fundamentals are bearish, slowing down, deflationary. Otherwise, if we'd have inflation, oil would be ripping. Okay. And we also had news on Thursday that Saudi Arabia says it was unwilling to help prop up oil prices and that it's fine with lower oil prices. I guess Trump paid them a call and said, you're not going to cut your production. Okay. And he leaned heavy into them. But whatever the case may be, here, during this entire period, we had the threat of World War III. Everything was going to be devastating. Oil didn't spike. It still maintained it. It went a little spike, but never went higher. It never formed a higher high or broke the downtrend, okay, technically speaking. So everybody was saber rattling, but the fundamentals and the technicals were telling you to don't fall for it. You know, we're telling you to say, oh, this is still bearish. Okay, we have bearish fundamentals, and after this break, we have bearish technicals. You should be holding this until the next level, which is probably around, like we said, $42 a barrel. So look, when things are going your way, you enter a trade and immediately goes your way, you hold it for a bigger move, okay? So that's what I'm going to be doing with this oil trade. Okay, the next thing that we look at is gold, my favorite. This is gold today. Went down. Okay, it was holding the whole week except on Thursday, May 1st, and today it held. May 1st was the big drop, but then it recovered. You can see the candle that has a wick here. It fell all the way to 3,200 and then closed on Thursday at 3,250, 3,240 something. The point I'm trying to say here is that gold is down, but at the same time, May 1st to May 5th is Chinese May Day. It's like a labor holiday. So the Chinese are not really in full force in the market. We'll have to wait and see how this goes when they come back, like on Tuesday of next week. But this to me, just look, a child can see we're still in an uptrend. Nothing has been violated. We haven't even come down to this level here. Okay, we're still extremely bullish. We're at 3,200, okay, as we speak on Friday. So despite the fact that maybe people try to take advantage of this May Day where Chinese people are not really buying, it's not, nothing has changed. The fundamentals are still bullish, and technically speaking, to me, this is very bullish. In fact, it's very healthy because if you look at the RSI, we were overbought, and now we're back to like neutral, okay? So you have an RSI recycling back down to neutral, Chinese coming back to buy, okay? However, there is a caveat, okay? The caveat that you should look at is that right now in the summertime in Q2 and Q3, we're entering a seasonally bearish time for gold, okay? Will it play out this year? I don't know. If it does, and we consolidate for a long period, let's say from 3,000 to 3,500, if we consolidate around this area for the next 3 to 6 months, okay? Maybe not 6, but let's say 3, 4, 5 months, it's very bullish in my view, okay? Because we didn't even drop, we're not even going to drop 15%. I mean, before this breakout in gold, okay? If I can go backwards, into, you had devastated, like this is the 2,000 top right here in 2020 to double tops. You know, you have huge drops in gold that stayed within this range, okay? These are big, big drops, okay? 10, 20%. Here, do you see any of this? No. So the only negative thing I can say is that we're entering negative seasonality for gold. However, if the fundamentals are there, and if Xi and the Chinese still keep buying, and all the BRICS countries still keep buying, I'm talking about their central banks, not retail. I mean, big institutions still buying. And if the West jumps on board, I don't know. We might get the rally in the summertime, okay? Although I'll be happy with a consolidation here. And having said that, gold might be consolidating, but the miners, okay, miners too have that huge, consolidation, inverse head and shoulders breakout. The miners might touch that. I'm looking at GDX, which is the major miners here, major gold miners. You can retrace the 45, even below and undercut it, and then go back up again, because as you can see, my target was here, because that is the previous high, 66. Okay, the 2011 halcyon highs. Okay, I expect it to get there eventually. Maybe not at that time frame. Maybe I should move it a bit here, but this circle, this is the target, which is a 66 level on the GDX. However, look, it just started. Okay, people are selling gold miners. They're selling it back down to not even the breakout point. That's pretty bullish. Okay, and this might, if gold consolidates and stays between the 3,000 to 3,500 level for the next 3 months, who knows? Maybe they're making a lot of money. Maybe people will start jumping into the miners because it's their chance to buy into a sector that is now printing money. Printing money, best free cash flow yield of all time. Okay, so look at the miner. Look at what happens to gold. Yes. Okay, will it consolidate because of the seasonality, or will it forget the seasonality and go into its fundamentals right away and start breaking out? In which case, I expect these miners to go. But look at the miners going into the summertime. If they still stay strong above the 45 level, that's extremely bullish. You're going to see a massive move going forward if that happens. If not, and they go all the way back down to like in the 30s, okay, we have to revisit. Okay, we have to revisit. But it would still be holding. It wouldn't be as bullish because we only be holding these levels from the past. This level here, which is one of my. The horizontal lines are significant levels. Okay, I think I've mentioned that 1,000 times. So when you look at my chart, these are significant levels. So to me, I am expecting flows to come into these gold miners as gold consolidates for the next 3 months over the summertime. Because now at $3,000 gold, if gold stays at $3,000 for the next year even, these guys are printing money. They should be going way higher. Okay, the relative strength of GDX versus gold, because now it's stuck at a doldrums, this is GDX over gold. I mean, if the miners are outperforming, they should go higher. So look at the 2011 level, okay? We're not even, no, that was the 2021, okay? No, the 2011 level. Okay, and even before that, but at 2011, the relative ratio was much higher. People loved gold miners versus gold back then. If we get that, it's going to be an explosion. Okay, we haven't had that yet. We're still at the lows, relatively speaking. Okay, like these miners should be printing. However, I don't blame people for not going into it because they've been burned in the past. But let me tell you something. These gold miners right now, these are not your daddy's gold miners. They're not taking on debt. They don't have stupid management. They are running their companies like well-oiled machines. Okay, they should be implementing a buyback program. That's the next thing that they should do. Okay, they should act like tech companies, like we said. But if they do that, people can come into this space and it'll be a game changer. But the reiteration of gold is that this is just a normal pullback, and I'm expecting it to hold the 3,000, which is here, to 3,500 level. This level is where I expect it to hold. Okay. What else? Let's go into some of the. Well, it'll be too long, so we'll save that for another time. But let's go into Bitcoin right now. This is this week right here. It's starting to break out into the 97K level. But we mentioned that we entered it around this consolidation period, and then it ripped. The next week we entered, boom, it ripped. So we got very lucky. I started unloading a bit, and I'm going to unload more of my miners. Hear about miners because they had a better risk-reward ratio than buying calls on Bitcoin itself. But liking the action. This is performing much better than SPY. Okay, near the high, SPY is coming there, but not right there yet. Okay, and if we get, we might go down if SPY hits that 575 level, because this goes with it. But you never know, because it never went down before when SPY went down. So Bitcoin is its own beast. Okay, so I started taking a little bit of profits. I'm going to take more when it hits the 100K level. So our Bitcoin trade is going very good. Our oil trade is going very good. Gold is consolidating. And what I wanted to touch on last is China, specifically BABA. This is my proxy China trade. Okay, BABA went down to the levels that I wanted it to go to, but it did it so fast that, you know, I like to play it with options. That playing it with options here was not very good, because the risk reward ratio, you could put like the 120 calls were like at 10-15 bucks, so they would have to go to like, for me, I need like a 4 to 1 risk reward ratio. It had to go to 160 for me to be worth it. I didn't know it was going to go to 160 before going down again, so it wasn't worth it. Okay, because the fast drop kept option prices high because the VIX was high. Okay, so I didn't enter the BABA trade again. I'm hoping that it comes back down and consolidates like it did here, so I could enter at a better risk reward ratio. Okay, but I'm still bullish China. If China and the US regulate their differences, it might not happen in like the next month or so. But if they do, I think BABA is going through the roof. So I'm still waiting to get into this trade. And if you look at FXI, which is the large cap Chinese stocks, I mean, it's pretty much the same story. Okay, we had a minus 61% drop. But China is still not near its highs. Okay, it's doing well. It's stair-stepping, higher lows, higher highs. Okay, and it's above, FXI is above this key level of 34. It's at 34.96 closed at today on Friday. So yes, I'm liking the Chinese market, but because the options were so expensive, and I like to play a leveraged game, I didn't enter them. Still looking to enter them, hoping they come back down and consolidate. Okay, so we haven't talked about China in a while. So there you go. Let's go back down to SPY. Let's get rid of this arrow. So we talked about our oil trade looking good, gold consolidating. We talked about China, which I still like, didn't get the chance to go into, and Bitcoin played out exactly like we said. So let's recap this market. Although short term, it ticks a lot of bullish boxes, which I like, and the sentiment here is still fear and extreme fear here, and positioning is still quite bearish. People don't believe this rally, yet we're still coming into heavy resistance to 575 level. I'm telling you, if this gets cut up, and there's no resistance here, it's extremely bullish. Okay, so to me, technically bearish because we're under the 200. Tactically, so let's say strategically still bearish, tactically bullish, so overall neutral. Yet I'm leaning towards a bullish move. If it hits this, drops back down and comes back up again and holds this level, I will be very, very bullish. Here, I'm reluctantly so. Okay, so that is the overview for this week, which was the week of the 28th of April. I'm looking forward to next week for new and exciting times to come. Later, guys.